Hello and welcome to Money Talks COVID-19 Daily Bulletin for Monday, March 30th. My name is Anthony Okolia. In a few minutes, we'll be speaking with Bart Melek. He's the Global Head of Commodity Strategy at TD Securities. But first, a wrap up today's market news. Prime Minister Justin Trudeau has announced the government will be providing a wage subsidy to support small and medium-sized businesses impacted by COVID-19. Details are to follow. Trudeau says the plan is to get companies to rehire employees. Investors are bracing for a longer than expected period of the coronavirus destruction. President Trump extended the CDC guidelines on social distancing until April 30th. The price of crude oil slumped to a 17-year low as the Saudi Arabia-Russia standoff and the coronavirus pandemic continues to dampen global demand. Meanwhile, heavy Canadian crude has fallen under $5 a barrel. Johnson & Johnson said that it has identified a leading coronavirus vaccine candidate and hopes to start human trials by September at the latest. The company also said it expects the first batch could be available for emergency use in early 2021. Finally, Canadian airlines are pushing for a wide-ranging aid package from the federal government to help weather the coronavirus pandemic. Finance Minister Marneau has made several mentions in recent weeks of the need to help the industry, but no specific aid package has yet been announced. While equity markets have been trading at significant lows since the coronavirus pandemic hit North America, the price of gold is actually up for the month. And my next guest believes that there could be more upside to this shiny metal. With more on this is Bart Melek, Global Head of Commodity Strategies at TD Securities. Bart, welcome.
Great to be here.
Bart, as I mentioned, the price of gold is trading up for the month, but it's still seen a lot of volatility. Why has gold been selling off along with equities at times?
Well, gold has been selling off primarily because of all the volatility that we've seen in the market, forced liquidations, and essentially we've seen people needing to cover margin calls. And all those factors have led to the sale of gold along with everything else. Though gold has outperformed the broader market, it did suffer as well. Volatility has impacted gold negatively, mainly because increasingly CTA funds and other systematic algorithms are very, very active in the market. And a key determinant in the amount of positioning that is being held, either on the short or on the long side of exposure, is very much determined by volatility. And as volatility spiked to record levels, the very crowded gold trade, which was very long, near record long levels, was being unwound because of the uncomfort of all the volatility. And of course, with equities plummeting and credit plummeting as well for a lot of corporates, funds had to basically fund redemptions, and they sold gold, and they also needed to cover margin.
Bart, you also put a note out last week that said that the gold price could push as high as $2,000 US an ounce. What are some of the factors that could drive gold to those levels?
Well, first of all, I think we need a little bit of stability in this market. This move towards the US dollar that has also been a very negative influence on gold price will have to be mitigated somewhat. Right now, there is still a drive towards strong US dollar positions. A lot of debt, some 85% of all debt issued globally has been dollar denominated. And as these firms get caught short, they need to accumulate dollars. And dollar relationship with gold is actually quite inverse. The stronger the dollar, the weaker gold tends to be. So that has to end first. And before we go to the 2000, aside from the stability I mentioned, we will have to see a little bit of recovery in the global economy. We ultimately think that the very massive amounts of liquidity and money printing that is going to take place over the next year or so will very likely continue to suppress interest rates for this foreseeable future, and we will have very strongly negative rates at some point, and low carry. It means that very likely a lot of investors will tilt towards gold as a safe haven, something that we've already started to see.
And Bart, are you not surprised that gold isn't higher, given what we've seen from the Fed providing unlimited liquidity? We've seen central banks around the world cutting interest rates, and there's even a question that we could possibly see negative rates.
Well, I would like to see it higher, but realistically, given what is happening with the market and the broad uncertainty and the move towards the dollar, I'm not particularly surprised. When we had similar things happen during the financial crisis, the slide in gold was about 3 months long or so. It was only after the Federal Reserve provided quantitative easing, QE, that gold started to move higher towards $1,900. Now, of course, this all happened in a fraction of the time, and this is why we didn't see the type of corrections that we've seen last time around. And I think we should be encouraged by that.
But I also want to touch on another note that you put out that could potentially have a big impact on oil prices, which of course we've seen have fallen dramatically. What's the word on oil?
Well, oil, sadly, we think isn't going to benefit very much in the, at least next few months, even if overall risk appetite improves. We've seen equity markets do a little better. They rebounded from the lows, and that was a response to, unlimited quantitative easing, various commercial paper facilities, the promise to buy corporate bonds and treasuries from Federal Reserve, and indeed central banks around the world are making similar promises and are very active in the market. Oil is a little bit different here because it is a physical commodity, and it is in a situation where we are having an unprecedented negative demand shock, which could, we think, take at least 15 million barrels out of demand in the second quarter. And if that wasn't bad enough, we have a price war between Saudi Arabia and Russia, and indeed the rest of the oil-producing world, where Saudi Arabia, instead of limiting production, has actually hiked production. And so we're going to get such massive inventory increases that they could very well overwhelm the world's, or certainly in North America's, ability to store it. And that could mean still some downside pressure. You have to remember, these are physical commodities. And if you have a glut, you have to put it somewhere. If you run out of space, that means prices will have to drop so low as to disincentivize any production by some agents.
And we only have a short time left, but I would be remiss not to mention Canadian crude, of course, which is really hurting and trading at an all-time low. Will the industry need a bailout to survive here?
Well, I'm not sure I'm qualified to say whether they need a bailout or not, but certainly when we look at the data, I think vast majority of all producers are most likely in negative cash flow territory. The problem in Canada is we have a lack of transportation, so we are getting a bigger discount, and there just simply isn't the premium left when you count the transportation costs to have prices that would help. Will it need a bailout? Probably they will need some sort of assistance to make sure they are liquid and they can carry on, that this liquidity problem for now doesn't turn into a solvency problem. But we think that this isn't forever in terms of this horrific price environment. We do expect an improvement in demand in the second half of the year as we move into Q4. And we do think that ultimately this somewhat irresponsible trade war that is being launched on this production war by Saudi Arabia, there will be some sort of mitigation. We're already hearing that the President of the United States is going to be talking to the President of Russia, and there have been suggestions that there could be some sort of a global agreement between key producers to cut some 10% of production. That would be very helpful.
And if you do see agreement, do you expect oil to rebound as well?
Not right away, because as I said, we will have literally hundreds and hundreds of millions of barrels of inventory accumulation. But over a longer term, over 9 months to a year, those inventories will weigh down. If we do have a rebound in demand after this crisis, we do see prices at over $40 towards $50, in a year or so, maybe a little longer. But that's certainly better for a lot of producers than the current 20, in a bit.
All right, thank you very much for your insights.
It was my pleasure. Thank you very much for having me.
And thank you for joining us. My name is Anthony Okolia. Please join us again soon and stay safe.